Welcome to our revision class. This is the 2023 paper, Financial Accounting. So question 1 is on ratios. Question 2 is on capital budgeting. Question 3 is on cash flow statements. Question 4 is on business structures. Question 5 is on conceptual framework. And question 6, we're looking at BEP. So start with what you know. We already did this question. Question number, though it was a little more applied. So I'll ask people to be attentive. I may not ask you to participate due to time. So we are given an analytical question with a study to say, your friend Jumbo has been carrying out business of rearing broiler chickens for the past few years. The business was not registered with PACRA, nor with ZRA. However, she approached to help her finalize the start keeping proper books of accounts and preparation of financial statements. She is aware that she can formalize a business by registering it as a partnership, a limited company, or as a sole trader, but seeks your advice as to which form of business she can register. Advise Jumbo on the advantages and disadvantages of a partnership, limited company, and a sole trader. So quickly, partnership is a business that has 2 or more participants. Exclusion of legal firms and accountants who are limited to only 20. So they are bound by a partnership deed, which is the constitution of the partnership. So now the key characteristics, I've mentioned them. So the advantages are as follows of a partnership. Let's talk about the advantages and disadvantages. So I'll run through the advantages and disadvantages quickly. So one of the advantages is that there's a pool of resource, there's a pool of expertise. So unlike a sole trader who's alone. So these advantages, is shared decision making, they contribute to the workload. There's a pool of skill because partnership benefit from each other's unique skills. There's access to capital because partnership can pool resources from multiple partners. There's also flexibility in management operations because it can allow partners to adapt quickly to the market changes. The disadvantages are that there's unlimited liability because each partner is personally liable for their debts, so meaning the personal assets are at risk. In the event of conflict, disagreements can arise. This may also affect the partnership. Profits are shared among them, so this is a disadvantage because generally the person would want to enjoy all the profits. There's also limited for potential growth because partners may face limitations of expansion and others. Again, a partnership is dissolved as soon as a new member joins or leaves the partnership. Any additions before I go to the other type of business? Okay, so let's go to a limited company. How would we advise Jumbo on the advantages of a limited company? So a limited company becomes a separate legal entity upon incorporation, according to Cap 388 of the laws of Zambia. It's a separate entity, the owners and the business. The business can sue and be sued. The advantages: number 1, limited liability because shareholders and the company are separate. So when somebody buys shares, they're only limited as far as what they invested in terms of assets. Number 2, separate legal entity. A company has its own identity distinct from its shareholders. So providing stability, continuity is only if shareholders change. So it has separate legal entity. Access to capital markets. So they can raise huge funds from the capital markets other than just shares that are bought. So they have a larger ability of raising funds. Tax benefits, they're eligible to tax deductions and incentives. So this will reduce the overall tax. The disadvantages, there are a lot of regulatory compliances that they're subjected to, like the corporate governance standards, holding annual meetings, and filing of financial reports. It's also costly to set up. It has double taxation. So there's taxation, which is what we call corporate tax, and also individual level. So this results to double taxation. So also the disadvantage is that the owners lack or lose control, because as they sell their shares, eventually what happens is the new shareholders will come and dilute the magnitude of power that they would have. So that is what we can say about limited companies. So we go to another kind of company structure, which is a sole trader. Advantages, that is simple and straightforward to start. You have full control, enjoy all the profits, and there's flexibility in adapting to market changes because you are the one who makes the decisions. Disadvantages are that you have unlimited liability, meaning your personal debts could be put at risk. Also, you have limited resources because you can only borrow from a few friends and a family. Limited expertise because you are alone. Of course, you can employ one or two. And also, business continuity is limited to the life of the individual. Once you die, but the sole trader dies as well. So, next question that was being asked was, explain why organizations prepare financial statements. Explain why organizations prepare financial statements. So there are many reasons why organizations prepare financial statements. Financial statements are important for decision making, for performance evaluation, for compliance, for creditworthiness, for tax purposes. So these and many more are the reasons why financial statements are important. So for decision making, they're essential to key stakeholders like investors, creditors, managers, because they will use these financial statements to make decisions about resource allocations, investment, and operations. They are also important for performance evaluation because it is from the financial statements that you can tell whether the institution is performing better or not. It is also through financial statements that companies are compliant. So once the records are produced in accordance with the standards, they are able to be produced for transparency and accountability. Investor relations. So financial statements also play a very critical role because from these, investors are able to analyze, and also prospective investors are able to use to make a decision. Creditworthiness. Financial statements also are used by creditors and lenders to evaluate how creditworth an individual is or an organization before they extend a loan. And for tax purposes, financial statements serve as a basis for calculating taxes. Are we together? Any questions or additions to this point? Is this clear? All right, so the last question that we have, which was carrying 8 marks, was classify any 4 types of costs relating to this business for the broilers. Any types of 4 costs? Who can identify the 4 types of costs?
Maybe the first one being production cost.
Okay, production cost. Yes. So the question here, if you read very carefully, you also need to classify them. What actual costs are there, and under what category are we classifying them? Are they fixed costs? Are they direct costs? Are they variable costs? Okay. this was a clever question. Those that have kept chickens, yes. Okay, so there's feed, there's labor, there's medication. So how do we classify these costs that we have?
Okay, let me try. We have the fixed costs, which are electricity
Mm-hmm.
and labor.
Yeah.
Those are fixed, maybe, but labor maybe not so much. Even the land where you're keeping these chickens.
Okay.
Yeah.
Okay, that's correct. So let me just assist also. We have the feed will fall under the variable cost because this will depend upon how the chickens are eating. We have labor costs, which is a variable because depending on how many chickens you have, how many laborers are going to. Medication would be variable because it depends on when they are sick and not. Utilities like water are semi-variable because it depends. Water could be fixed. All right, so these are the classifications that you could have identified. Okay, are we together? Does that make sense? Does that help?
Yes. So the land is not here, or it can be put up where you're keeping the chickens.
Well, yeah, on the land, you'll be talking about what? Rates or what? Or the cost of buying the land. Yes. It's very, very good observation. You can add it. Okay. Okay, so let's go to
So in this case, the land or the property cost, is it fixed or variable?
it depends. It could be an implicit cost or explicit depending on who the owner is. So if you're renting, maybe you're going to call renting of the place, the premises. Okay, that would be a fixed cost. Okay. So that property being a fixed asset. So here we're looking at costs. So it would be under fixed, yes. Yeah. So you need to be very careful as to how you answer that question. All right. So we proceed. So conceptual framework for financial reporting contains the qualitative characteristics of financial information, namely the fundamental qualitative characteristics and enhancing characteristics. So with use of examples, explain how each of the four enhancing qualitative characteristics will enhance the two fundamental qualitative characteristics. So to start with, what are the enhancing and what are the fundamental characteristics? Who remembers?
Fundamental would be faithful representation, as well as reliability. Then enhancing would be verifiability, compatibility, comparability, not compatibility, but comparability. Yeah, I think so.
So we made the formula, remember? Those who said cat what? Cat V, then RF. What do these stand for? And which ones for which ones? So C for comparability, U for understandability, T for what? Timeliness, V for verifiability, and R for reliability, F for faithful representation. So which ones are fundamental and which ones are enhancing?
RF fundamental
Mhm.
and it's UTV for enhancing.
All right, okay. So now let's go to a question.
Sorry, let me just take you back.
Mhm.
Sorry, it said CAT V, C
Mhm.
standing for comparability, U understandability, T timeliness, V verifiability, and these are under which one? Enhancing qualitative characteristics or fundamental.
Yeah, there's a question for everyone. And those two, which ones are fundamental and which ones are enhancing?
Okay, so RIF is fundamental and then CAT V is enhancing.
Yeah. Is that
So
clear?
RF is reliability and which other one? Flexibility.
Faithful representation.
Sorry,
So these two fall under what? And these fall under what? These ones are fundamental.
fundamental. Yes, I've gotten that one, but I'm saying
These ones
under
are
fundamental, the acronym RF.
RF stands for what? R is for what? Reliability. F is for faithful representation.
Thank you.
So now, by use of examples, explain how each of these four enhancing characteristics, which is CAT V, okay, enhance the two fundamental, which are RF. Okay, it doesn't even give any clue. How many marks? 12 marks. So let's start with CAT V, comparability. How does comparability enhance both reliability and faithful representation? Okay. How do they? So this one was a packed question. The very packed question. So let's start with comparability. So I will try as much as possible to be fast. We don't have time. So for comparability, C, I'll break it down to explaining the two bit by bit. So how does comparability enhance both reliability and faithful representation? So in terms of reliability, comparability will allow the user to identify patterns, trends, and consistencies across different period or entities. So this will assist in assessing the reliability of the financial statements. That's where ratio analysis comes in. So comparability, it will help identify trends across different periods or different years. So by assessing this, the reliability will be highlighted. Secondly, enhancing faithful representation. So at that note, comparability will ensure that the information is not only compared between entities, but also facilitate that they have a faithful representation of the economic phenomenon. For instance, if their accounting periods are consistently applied across comparable companies, it will enhance faithful representation of their what? Financial position. So you get your, how many marks? 3 marks for that. So we go to another aspect, which is verifiability. How does verifiability enhance faithful representation and reliability? So you explain it as follows. If somebody keeps writing on my screen. Okay. So ME will be at what? 130. So in terms of verifiability, how does it enhance reliability? It will allow for independent parties to confirm or validate the financial what? Information. This will increase the confidence in its reliability, such that when the financial information is verifiable, users will rely on it for verification. So for instance, if a company, the inventory valuation can be verified through fiscal counts and reconciliation, it will enhance what? Reliability. So this question really triggered that we also give examples. Okay. So any questions so far? Any questions? Okay, so we go to timeliness, or cat V. So C, we're done. We're supposed to go to U. U is what? Understandability. Understandability. This is how understandability could be coined in. Understandability will enhance relevance and faithful representation, because once the financial statements are understandable, they're more likely to be used for decision making and easily comprehended and applied for decision making. For instance, if financial statements are presented in a clear and simple language, investors are more likely to understand the company's financial position and therefore make informed decisions on their investment decisions. Enhancement or enhancing faithful representation. So understandability also, after the financial statements are well presented in a manner that is accurate and represents the underlying economic phenomenon. So when the statements are easy to understand, users will have confidence and that they faithfully represent the true financial position and performance in their reporting entity. Okay. Then we go to timeliness. Timeliness. In terms of timeliness, so enhancing relevance, timeliness will ensure that the financial statements are provided promptly, making it more relevant for decision making. So by reflecting the current economic conditions and events, timely information will help users make informed decisions. For instance, quarterly reports are released shortly after the end of the reporting period. So investors will use them to assess a company's recent performance to a certain prospects. So this is how this question was supposed to be answered with ease, without panicking. So we are done with our, we're remaining with the last part. Part number C. Use examples to describe the accounting information needs of the general public, government, and journalists. This one was a 3-mark question. So who wants to try? Okay, here's a question.
Mr. Collins, I think you've skipped one question there, question B.
Oh, okay. I'll get back to it then. Let's go to this one. For this question, we are asked using examples, describe the accounting information needs of the general public, government, journalists, and analysts. So 5 marks. For what use is accounting information to the general public, government, and okay, what use is it? Okay, let me quickly go through them. The general public, how to put this information. So for the general public, number one, they use this information not directly, but to be consistent with activities like consumer or social corporate responsibility. So when there's a neighborhood that has a bakery, so the product community unit would want to really know how well this bakery is doing, so they could be assured that its profits also go to helping out in the area, okay, through their patronage. Government, why is government interested in financial accounting information? This information is needed for what? Purposes of tax collections. So they want to estimate whether you're tax compliant, was through taxes that government will plan for the economy. Journalists would also want to know this information for publicity in the media. Okay. So for instance, the media is trying to scrutinize the performance of companies in the particular sector. So they'll examine the financial statements, the cash flows, Auditor General's report. So we also have analysts. Analysts are also keen to this information. For what use would they be? These ones would be interested to see and assess the financial health of the particular sector so that they could give proper advice to would-be investors. Okay, so the question that we skipped also, the question that we skipped, part B, reads, explain what measures have been instituted by the accounting profession to ensure that accounting information is truthful and valid. The accounting profession has put in key measures. Okay, we've heard of the GAAP, generally accepted what?
Accounting standards.
Yes, so to ensure that there is validity, accounting has put in measures by bringing in what are called generally accepted accounting principles, GAAP, which provides standard framework for financial reporting, ensuring that there's consistency, comparability. They've brought in auditing, which involves an independent examiner to scrutinize the financial statements to ensure that they're in compliance. They've also brought in what are called internal controls. These internal controls involve maintaining accuracy and integrity in the accounting profession, which include policies and procedures. They've also brought in regulatory oversight bodies such as the Securities Exchange Commission, that is both in Zambia and the US, the FIC, we have FIC, Financial Intelligence Commission, is it? We also have the FRC, Financial Reporting Council. They actually have FIC as well. So these ones are there as whistleblowers, ensuring that there's compliance. We also have professional ethics. So the accounting profession upholds strict code of conduct, which represents accountants who have a certain level of integrity. In Zambia, we have Zika, other accounting bodies like CIMA, SSA. They've also continued to ensure there's professional education. people who are accountants in Zambia are required to be affiliated with Zika. So they undergo that, so to ensure that there are standards, and also technology automation through the use of software to automate and help ensure accuracy in financial reporting processes. In Zambia, we have Smart Zambia that is also integrating these so much more. Are we together? Are we together? Any questions? Okay, so we've looked at these. Then maybe let's look at financial ratios. So before I look at the financial ratios, I need to bring in keynotes on financial statement analysis, what it's all about, what formulas we have, and what these formulas talk about. We have different ratios that are here that we've been asked to utilize. Which ratios are these? Okay, so we have gross profit, return on assets, return on equity, average days. So let me briefly explain these ratios and what they talk about. So to start with, financial statement analysis basically is used to make comparison of the performance past, present, and future of companies. So now these ratios are basically used as part of comparison, not in isolation, they're interpreted in the context of the company's what? Strategy. So they look at the financial and non-financial aspects of a business. They give the scenario of how the business is performing using the income statements, the balance sheet, and the cash flow statements. So we have different kinds of ratios that are used in here. We have what we call liquidity ratios. These ones measure the company's ability to meeting short-term obligations. We also have profitability ratios, efficiency ratios. So all these have a purpose. So it would be very important for you to understand the purpose of these ratios so that as you make interpretation of them, the information is informed. So here are some of the ratios that we have and their purposes. So I'll ask somebody to just talk about the ratios. I've dimmed them there. Talk about what they talk about. All right, let's start with you, Mr. Nkata. Talk about the liquidity ratios. What can you tell me about the liquidity ratios? Then we'll go to Eunice and Annie. Pick on any ratios. The notes are there. Just explain what they are all about. 1 minute each.
Okay, let me talk about the profitability ratios. These ratios measure a company's ability to generate profits relative to its revenue, assets, or equity. And the common ratios to under this profitability ratios are return on assets and return on equity as well as a gross profit margin. The higher the ratios, the better the profitability. According to what's there. So
Alright.
for example, the formula for gross profit margin.
We're here, we're listening.
I'm sorry, I have to connect with my phone now. My laptop has gone flat and no charging here.
Okay, so let me pick it up. So thank you so much, rightly said. I have 5 minutes before we end. So we have liquidity ratios. Basically, when you're liquid, you have money. They measure a company's ability to meet its short-term obligations. So we have the current ratio, the quick ratio, the cash ratio. So ratios should be above 1 to sufficiently cover their short-term obligations. So we also have profitability ratios. These ones measure the ability that the company has to generate profits relative to its revenues. So the common ratios that we have are return on assets, return on equity, gross profit margin, net profit margin. So the higher the ratios, typically, we're talking about a better profitability. So we also have ratios like the efficiency ratios, which basically evaluate how a company utilizes its assets or resources to generate sales or revenue. Examples are turnover ratio, inventory turnover. So the higher, the more efficient the company is. So we're looking at how the company is utilizing its what? Is utilizing its assets to generating sales. So what other ratios do we have? We also have what we call the debt ratios, the market ratios. These ratios are also very important. So what the debt equity ratio or the debt ratios talk about? So these ratios gauge the extent to which the company is leveraged. So the more leveraged, the dangerous. So when you're leveraged, meaning you're financed by debt, right? So can we go to the calculation? Have we understood all the ratios? Let me go through them quickly again. So we've talked about the ratios, like the gross profit margin. The use is it measures a percentage of the revenue that exceeds the cost. So it indicates the efficiency that we have in production. So a higher gross profit margin basically means that we are managing our costs better. We also have what we call return on assets. The use is that it measures the profitability relative to its total assets. So it indicates how the company is using its assets generating profits. Okay. So we also have other ratios like return on equity and average data collection days. So return on equity basically evaluates the profitability of a company relative to its share equity. So it allows us to assess how efficiently the company is generating profits from the shareholders' investments. So the higher the return on equity, the better the returns. We also have the average debt collection period, which measures the average number of days it takes for a company to collect its account receivable. So the significance is that the shorter the period, the more efficient our credit management department is. All right. We also have other ratios like the credit payment period, the current ratios. Okay. So the use of the creditor payment period is basically the average number of days it takes for the company to pay its creditors. The significance is a longer period may indicate unfavorable payment terms, financial strength. So it would be a bad signal that if we're taking so long, creditors will most unlikely want to give us on credit. We also have the current ratio, which measures the company's ability to meet its short-term obligations. So if the ratio is above 1, meaning we have enough liquidity to meet our short-term debts. So we also have the asset test ratio, okay? And we also have the interest cover ratio, and the debt to equity ratio. So the use of the asset test ratio is basically to assess the ability to meet its immediate obligations. So significance is that we want to see what we can pay for, excluding our inventory. So we also have the interest cover ratio, which measures the ability of the company to cover its interest expenses with the operating profits. So if we have a higher ratio, it indicates greater ability to meet our interest obligations. If a lower ratio, it means that the interests are exceeding what we're making. And we also have the debt to equity ratio. This measures the company's total debt to equity. So it reflects the company structure and the financial leverage. So a higher ratio indicates higher financial risk due to increased reliance on what? Debt financing. Okay. I hope this has been helpful. Are we together so far? Now let's go to our financial ratio or our financial report. So we have the gross profit written after explaining what each of these works. So we now need to analyze. So let's look at the profitability. So the question part A is asking us to prepare a detailed report of the financial performance of this company based on the ratios above. So I'll take 5 minutes. We'll have another class just now. So let's go to our gross profit. Okay. So what can we comment in terms of the gross profit? So we can see that the gross profit has remained stable at 38 in 2021, similar to the previous year, but it has fallen short against the industry average and against some competitor ratios. So we've been static, but we've also been beaten. We've been beaten in 2020, which is 40%. So here, at least we've beaten this. So let's go to our return on assets. Can somebody explain? Okay, so we've seen for, okay, let me add to say that although we've remained static, there's been a lower gross profit margin relative to the industry peers here. So this suggests that we were kind of inefficient in our pricing strategies, and it would indicate that maybe we have higher production costs, which have made us unable to pass on the costs to customers. Let's go to return on assets. So on return on assets here, we can see that from 20, there's an increase to 5% in 2021. We have beaten the industry average in 2021, but also beaten in, we were beaten in 2020. But in terms of our competitors, we beat our 2021 competitors, but we're the same with our 2020 competitors. So the implication is that there's an improvement from 3% to 5%. This indicates that there's efficiency in utilization of assets. However, we're still below the industry average. So the implication here is that the return on asset, which looks at how effectively the company is utilizing its assets to generating profits. So there's a higher return on assets, which means we are better utilizing our assets to produce profits. So let's go to our return on equity. What is happening on return on equity? So from 1% to 2% there, this is showing that there's an increase, but we still remain below both the industry and average competitors. So here, although we have an improvement, but we are below both the industry averages and the competitor averages here. They're being beaten. Okay, so What is the explanation to that? So the return on equity is used to measure the profitability that the company has relative to its shareholders' equity. So we know that when we have a higher return on equity, there's better returns for the shareholder. They're happy. Now that increase here suggests that, okay, yeah, we've generated higher profits relative to the shareholders' equity, meaning we are doing well on the shareholders' equity. However, this ratio is below par when it comes to industry peers as well as our competitors. So this effect will affect the investor confidence from our side. Internally, we are celebrating. Externally, are we? No win, no win. Are we together so far? Are we moving on the same page? Any questions? I'm interested in the newcomers. Where's Deborah? Okay, they don't know how to activate their audio. Okay. Any questions? It's loud and clear. Okay, so average data collection period. Average data collection period. So from our analysis, average data collection period is under efficiency ratios. So these are about how well we are utilizing departments. So average debt collection period has increased from 25 days to 35 days. So the implication is that collection period, which measures the number of days it takes for the company to collect its account receivable. So here there's a longer stretch of a period, which indicates that we are not doing very well in our debt collection. The average debt collection period, the average credit payment period, looks about the period it takes for us to collect our monies and to pay our money. So from there, we can see that the average debt collection period increased from 25 days to 35 days. So the implication is that debt collection in our case was taking longer. So this longer period indicates that there was slow collection of the receivables. Maybe this could have come about because of the cash flow or liquidity problems that our debtors were having. So the increase in AA's debt collection period suggests that the company is taking longer to collect what? The payment from the customer. So this could lead to cash flow challenges and working capital constraints. It's not a very good thing. Okay. Then we go to the other one, which is the average credit collection period. So here you can see what's happening on the credit collection period. What's happening on the credit collection period? It's also increasing because of the ripple effect from 55 days to 65 days. Maybe the average is because of the number of days it also took us to be paid. So this long period may be a bad signal where we're taking too long from 55 to 60 days. So these issues could have been perhaps maybe that our data has took long. So this may suggest that the company is taking very long to pay suppliers. So this would impact our relationship in cash flows. Okay, so what other ratios did we have? We had the liquidity ratios where they have the current ratio and asset test ratio. Current ratio and asset test ratio. These are under liquidity. So here you can see that the current ratio declined significantly from 4.9 to what? from 4.9, it went down to 2.5. This sharp decline is very scary. This sharp decline is very scary, but we are still above the industry average. So this current ratio measures the company's ability to cover its what? Short-term obligation. So a higher ratio indicates that there's better short-term liquidity. So the decrease in the current ratio here suggests that there's a reduction in the company's ability to meet its short-term obligations. These could have been as a result of maybe low cash flow issues and also an increase in our short-term debts. The asset ratio or asset test ratio, which is also known as the quick ratio, is used to measure the company's ability to meet its short-term obligations for the most liquid assets. So if we have a higher ratio, it means that we have a better liquidity. So in this case, we are seeing AA PLCs decreasing from 1.8 to 1.5. Of course, it remains in line with the industry averages that we have. So from 1.8 to 1.5. 1.5 is the industry average, which is still there. And this is that. So we are, however, below our competitors. I mean, we need to pull up our socks. So this decrease basically suggests that there's a reduced ability to meet our short-term obligations with the most liquid assets. So this could be a decrease from our cash and cash equivalents to meeting our short-term obligations. Finally, we have these last two ratios, which fall under capital structure ratios. So these capital structure ratios, basically, the debt to equity ratio is used to compare a company's total debt to its shareholders' equity. So it reflects the capital structure or the financial leverage. So if we have a higher ratio, it indicates that there's higher financial risk, which is there due to increased reliance on on debt financing. So here, the increase in our debt to equity ratio, there was PLCs, it increased from 55 to 65%. So this increase basically suggests that the company took on more debt to equity. Potentially, this was to finance the company if there were investments that were taking. So this higher leverage indicates that the company has a financial risk ahead. Interest expenses, this could impact the profitability of the company. So what is our overall remark? So overall remark is that AA's financial position exhibits mixed results of profitability, liquidity, and capital structure. So whilst there are areas that need improvement, like the return on assets, return on equity, there are also concerns in the trend that there's declining liquidity ratios, also increasing leverage ratios. So the company here should focus on basically optimizing the capital structure, improving the liquidity management rate, and also enhancing the operational efficiency. So this is how this report was supposed to be analyzed. Isn't this interesting? Isn't this interesting?
It is.
Easy, right? So,
It's interesting but easy.
well, I've made it less tedious, okay? I've sent you the analysis for you to read on your own in the paid up group. So just read it through. It will be helpful. Thank you so much for your time.